What is going on, everybody? Welcome back to another video. With that being said, I want to jump right into this one because I think this is a very important strategy that people are not utilizing enough in order to maximize gains. Okay guys, credit spreads. There are two different things here you're going to look at: a call credit spread and a put credit spread. For any of you people that are new to trading and new to options, not only can you buy a option, you can also sell an option. Now, of course, there are different costs and everything associated with that. So if you are brand new, I have some other videos that are going to teach a little bit easier lingo here and stuff like that, but this is still a strategy that you need to know and that you can understand. And I'm going to show you an exact example of the ones that I do for a couple of benefits to my account, and I'm going to share both of them with you. So the first one is going to be cost reduction, and the second one is going to be risk reward, and the actual risk of what you're using and the probabilities of success. Because it's a lot of things that everybody looks at risk reward and they go, oh my god, you're risking $200 to make $20. Yes, that is theoretically true, but your probability of winning that trade over and over and over is a much higher statistical standpoint than you buying $100 call option that's going to expire tomorrow and you not making money on it. And I will go through all of that here in just a second. So I want to explain what it is. So you guys know I have my Robinhood account, and I absolutely love it. We're going to go with SPY here on this one because this is the most traded one. It's very, very liquid. When I say it is liquid, meaning there's always people trading, and you can get in and out of it very easily without all of the hassle on something that is illiquid. So the first one I would want to go through here, though, is a put credit spread. This is just a diagram of what it is. Does this look fancy? Yes, it is. So that's why I don't like using these structures. I'm going to go through it with you and show you exactly how it works. So this one here is going to show you essentially here, but I want to walk you through how you would build the trade and why you would do it. So I got SPY charts up here, and you guys see I have this one here. This was from a past credit spread. So, and I do sell these naked as well, so that is an option. Doesn't mean you need to do that. So the first thing, though, is figuring out a stock that you like and you think that's going to continue to uptrend. So for instance, SPY, the S&P 500, over time always goes up if you watch it. So first thing I'm going to do is I'm going to figure out, roughly where is a 15% probability, 15 to 20% probability. So I'm going to go to Trade SPY options, and we are going to go to sell. Now this is the key part here that a lot of people don't understand, is you can sell these options. 90% of buyers don't make money, and that is a CBOM, I think. I may have missaid that, but that is a statistic from them. So me, I'm going to go to a put. I don't like selling calls near as much unless I own 100 shares of that stock, and then I will sell covered calls against it, and that's a whole nother video. I have plenty of those, but this is just to make some income. So me, I like to go out a little bit further than a lot of other people. So me, I'm going to go out here to this 46 days. Now, I am recording this on a Saturday, so these are kind of fixed prices, and they will wiggle a little bit in real time. It's just how the market works. Everything's always moving. So it's usually within a couple of dollars, though, because this was the closing price. So first thing I want to do is I'm going to figure out where I want to sell. So this gives you a chance of profit up here highlighted. This is a big fee. So what this measures is delta, and you don't have to understand all of them. It will over time help you. But basically, this is going to be a 0.20 delta, meaning there's an 80% chance of this expiring out of the money. It's exactly what that means. So I'm going to go find this one right here. And, maybe it's a little over that 20. So we're going to go, we want a 81% chance. It's just perspective here. Me, I'm going to go back up here to this 457. Now, what I'm going to do is I'm going to go over here to Trading View. I use Thinkorswim on a day-to-day basis, but 457. So this one's going to be a little bit closer probably than I would really, really like. And we're going to move this down here to the 457 mark. Close enough. So what I'm going to do, I'm selling this put option. I am betting that the market is not going to come down to this price range. I think that's probably a pretty decent bet. And here's my thing is I would like for us to have a really good red day, one of these big red candles for me to sell a put on SPY. So, but for this instance, whoa, I didn't mean to click that. So SPY put, we have this one. I'm going to sell it. Now, you're going to see instantly right here, $45,000 is your max loss. You're like, whoa, but I'm only making $273. This is not the whole trade. We still have another step to do in this. I'm showing you what would happen if you sold this naked. So, what you also can do here, though, is we are going to switch back to a buy. So, 457 is the higher strike on this, the one closer to the money. That is a very, very key point here. Then we are going to go over, and I like to get 5 points, and I'm going to show you the difference why, but for this one, we're just going to do a dollar wide. I'm going to show you the difference here. So I'm going to buy this one. You're going to see I'm going to collect an 11-cent credit. You got to make sure that this line says credit, because that means they're going to give you a credit. You are receiving money. A debit means you are paying. For any of you those that don't understand that, it's a simple banking term, and that's why they use it. So this is a credit. I'm going to get 11 cents, and I'm going to risk $84. So this actually is a very good return on cash, or return on money, ROI, return on investment, whatever language you want to use for this. So now this is a great trade for somebody that doesn't have a lot of money, can wait the 46 days. You're going to get it, and you're going to start getting a little bit of a rhythm. If you have $400, you can trade 4 of these, or you can trade 1 every single week. And those are things that I did when I first started out doing these. So, but I'm going to actually, I don't want to buy that one. I like going $5 wide. And what that means is I sold a 457, so I'm going to go 1, 2, 3, 4, 5. And I'm going to sell the 211, or I'm going to buy back the 211. Now, what did that do here? I'm going to show you here. So my max profit is $62, but my max loss is $434. So it's still a great return on your cash. Great return on your cash. But here's the difference. This one right here that you are buying is going to go down in value pretty much a lot quicker, and you're just going to see profits faster is what I'm saying on why I get a little bit wider and I risk a little bit more per trade. Now again, I'm not selling this unless the market comes down. I want to get even further out with a better probability, but that's for a whole nother video and deep diving into this. So now what we have and what we have set up is I'm selling a 457 put for 46 days out. My probability is insanely high that it's not going to come down to the 457 is what you're doing. Now you can increase your probability by going further out of the money. If we wanted to go sell a 455 or probably a 452 or 450, we could do that. You're just going to receive less credit for the amount of collateral or money that you have to put up. Now again, those are your trademarks that you have to do there. And it's a very, very simple thing. And that's what this is showing right here. The stock price is at 101.50, sell 100, buy back at 95. They're making a 5-point spread here. So, but I feel like showing it to you guys on this makes a whole lot more sense. Showing you guys, because I know a lot of you guys use Robinhood, or a lot of newer traders use Robinhood. Use this, and it works really, really well. Robinhood's fees are way lower than somebody like TD Ameritrade and E-Trade that I use quite a bit. So this is the trade here. Now, if say you don't like only the 80% probability, I get it. We're going to get rid of this trade, and what I talked about earlier is we are going to go out. I need to go back to sell. Chance of profit. I would at least go to 15, so you're probably selling this one. Some of you guys can go down to 10, which means 90% probability. You're just not going to collect as much. So I think 15 is at least reasonable. So I'm going to go back here, and again, you're just going to buy or sell that one, buy one back. You're only going to get, now see, you're only getting max profit is $10. Really, your total credit's $6, and you're risking $100. So you're making 6% in a month. It's not bad. I'm not saying that's bad whatsoever, guys. If the whole market averages 8 to 10, 12% a year, that's not a bad return if you're doing this consistently over and over and over. And now you understand how people like myself and other traders in this industry continue to beat the market year after year after year. Now, with that being said, you can do this with other stocks as well. All of them that have options have this opportunity available. Now, again, this is not the trade that I would be doing. Now, what I mean when I'm not doing this trade, there's a thing called implied volatility that it's a little bit more in depth. If you've made it this far in the video, you're either new or you've never heard of it, or you're new to selling options. That's 100% okay. Implied volatility is just the volatility, the VIX. I don't have it up here, but how much the VIX moves. And you guys can see the VIX spikes. And if you line up these dates, when the VIX spikes, it basically meant that the market went really pushing downwards. You can see it basically is the inverse of SPY, which is 100% okay. So if you look at the credit that we were going to receive for the trade that we just put together on Robinhood, now if you waited and on Monday that the market comes down even further, you would get more credit if you did that trade than if you did it on this massive green day. I would not sell a credit spread on this massive green day, a put credit spread anyway. I would maybe sell a call credit spread. But again, like I said, my preference is I don't sell call credit spreads a lot unless there's a massive up day, like I think it was on Wednesday because of the Fed meeting. Those are other things, other economic calendars that you guys should definitely look at to understand which days are which and why you need to know. Because a Fed meeting, a CPI report over the past couple of years, but Fed meetings really are the ones that are going to move it. Just like if you were in trading oil, which I believe is UCO. Anyways, if you traded oil, Wednesdays would be the day because that's when the demand and stuff and the amount of oil, that report comes out, basically. So with that being said, thank you guys all for watching. Again, don't go and do 100 contracts of this at once. Go $1 wide, go $5. Do whatever you feel in your risk tolerance allows. Me, if I was going to go and do this trade, I would be at 20 or probably a little bit further out due to I think it's going to come down. So, again, you can come out here to that 450 like we were talking about, sell it. We're going to go buy another one. You can go $1 wide, which means you're only going to make $6, or 1, 2, 3, 4, 5, $1.49. Now you're making 38 cents for 40 bucks. Again, your return on investment goes down because you're further out of the money and increasing your probabilities. I understand what you all are thinking right now. But again, that's why a lot of times you will see me go up here into that 20%. And then another thing that I like to do is if I'm doing this on stocks that I can buy, so worst case scenario, I will end up buying the shares. I know not everybody has that opportunity, but it is just something to be thoughtful of. But at a 20%, I'm making 11 cents on $100. This is actually a pretty good trade as long as you truly don't believe that SPY is going to come down. And again, remember, implied volatility is a thing. So thank you guys all for watching this video. I hope this helps somebody out. Please leave a comment below if you made it this far saying something crazy. That way I know you made it this far. Thank you guys, and I will see you guys in the next one.